Good morning, I'm Sean Hannigan, Chief Investment Officer for Aurora Capital. Well, Q1 2026, what a quarter. January was a continuation of the prior couple of months, with AI concerns taking the steam out of the Magnificent Seven and other areas of the markets doing a bit better, namely European equities, small caps and global listed infrastructure. So our growth fund eked out a small positive return, while our conservative fund was slightly negative. The funds were a bit like the proverbial duck in a river, not moving anywhere but legs paddling furiously beneath the surface. The month of February generated strong performance, with equities generating positive returns. However, the real story for us was the performance of our global equity managers, which outperformed the index by 2.2%. Our overweights in global listed infrastructure also proved beneficial, with the sector doing 9.5% for the month. And then the wheels came off in March, with US and Israel invading Iran and the subsequent closure of the Strait of Hormuz. This caused oil to spike, reaching a high of over $115 a barrel, which in turn hit financial markets badly. The New Zealand dollar fell, reflecting the market concerns that the spike in oil and diesel prices would impact New Zealand's very fragile economic recovery. Oil and financial markets were whipsawed over the month as prospects of a ceasefire ebbed and flowed. Global equities fell 6.6% over the month, with New Zealand equities down 5.8%. So while our growth fund generated a negative return of 4.9% for the month, over the quarter it was slightly over minus 2%. The 1 year and 3 year numbers still remain very healthy at 7.8% and 8.6% per annum respectively. It is during these periods of volatility that the benefits of diversification are highlighted. So while the quarterly numbers for global and New Zealand equities were negative, we had strong performance for our global listed infrastructure at over 12% for the quarter, and our New Zealand private credit, which generated nearly 1.6%. This diversification was particularly helpful over the quarter, as the typical diversifier to equities, fixed income, did not help. Both global and New Zealand fixed income generated negative returns for the quarter due to the concerns about inflationary pressures caused by the higher oil prices. So while markets have been challenging, our approach at Aurora Capital to focus on diversification to try smooth the investment journey has proven its worth. The benefit of advice also becomes evident during volatile markets. Short-term market falls should not be a concern if you're in the right fund and risk profile. As I've said before, if you're not planning accessing your money for many years, market falls are an opportunity to purchase cheaper assets. If you're not sure if you're in the right fund and the right risk profile, please reach out to your advisor to get some advice.